Starting now.
Awesome. Then I guess we can start and then let the other ones join later. But thank you everyone for joining to another session of Let's Talk About Regulation. These are monthly sessions that we are organizing with the IOTA Foundation. So you can learn a little bit about the different regulatory challenges and opportunities that we have worldwide. And today we have a really interesting topic for everyone with Max Berndt. Max is the Chief Legal Officer of BlockBit and also sits with me on the board of directors of INAPA. So we have been working together for quite a while already in different topics. So I asked him to share all his knowledge about taxes, especially tax regulation, with all of you, which I know is going to be a really interesting topic and a complex topic. And interesting among everything else, especially for the Germans. So I'm going to hand over to Max, who is going to try to put like this complicated topic in the easiest way and the easiest possible way for us. And everyone, feel free to make questions about these slides or any topic or any doubt that you have in regard to taxes. I will leave it up to Max to decide which of those questions he wants to answer and which one he will let pass. So thank you, Max, for joining us today.
I'm wondering if the others hear Max, or is it just me?
I can hear you, but if Laura cannot hear you, then we have an issue because she's recording. Just let me... Laura, can you hear me? Laura?
I can hear you, but I can't hear Max.
Then maybe reload it, because like I reload and then it was working.
Okay, I'll do it. I'm back in a second.
Laura, are you back?
Can you hear me?
Now is perfect. Thank you. Yeah. Can you just start over, please?
Just start all over. You, Max, I already said my part, so you are the important part. So sorry for that one.
Sorry, no Max. No. Sorry.
No all right.
You can start directly, Max.
Okay, perfect. Thank you, Mariana. Pleasure to be with you guys today. So maybe just to disappoint some of you guys, I won't give any taxation advice today, or I won't go into much detail about taxation on a national level, since taxation across borders is just very, very different from country to country. There's lots of different tax regimes. So this is something which is up to tax advisors. So no financial advice here, of course. But what I will go deeper into with today's presentation is rather the questions that really lie off the heart of most crypto traders. Mostly, can the government, or amongst others, can the government actually trace my tax liability? I think these are issues many are concerned about, especially after the latest international regulations that were just enforced. So maybe I'll start straight with my presentation and the main points I want to discuss today. First one is international tax reporting requirements. These are new regulations which have been, on the one hand, enacted on a global level, on the level of the OECD, and another one on the European Union level, which is the MiCA, the Markets in Crypto Asset Regulation, and the so-called DAC8, an update to the tax framework. Then I will discuss the implications for individuals. What are the implications of these international reporting requirements? Do they lead to increased tax transparency? Yes or no? What about the status of monitoring and tracing opportunities from national authorities and governments? Third point I want to discuss, just on a shorter note, is the taxation at the national level. Crypto as a new tax phenomenon, and taxation as a pillar of state sovereignty. which is also something which is the reason why there's so many different tax laws. And lastly, I will go on the point on how to solve the issue of filing proper tax returns, because I know don't file the tax reports or tax returns mostly really struggle with that and don't really know whom to trust or whom to rely that with. So let me start with international tax reporting requirements. By the end of October 2022, the OECD, which is a global organization covering the most important states in the world from business-wise, so the biggest ones, concluded in October 2022 the crypto asset reporting framework. This crypto asset reporting framework, which is called CARF in short, introduces global tax reporting standards for specified crypto asset service providers, which are called CASPs, or on the level of the OECD, often also VASPs, which means virtual asset service provider. So in total, what does this OECD this CARF introduce is that these service providers will have to report user transactions on an annual basis, on an aggregate basis by type of crypto asset, and distinguishing between outward and inward transactions. I will go into more detail about that in a minute. And on the level of the Union, which is below because it's just focused on the European Union, of course, there was a new regulation introduced in the form of the 8th Amendment to the Directive on Administrative Cooperation, which is called the DAC8 in short. This is still being negotiated, so right now we don't really know what it ultimately will look like, although we already have a quite clear picture because the proposal of the DAC8 has been released by European Commission on the 8th of December 2022, so also by the end of last year. And this is going through the European Parliament as we speak. So the taxation issues are subject to each European member state's approval. So of course, it's never easy to agree on a matter of taxation. What does the DAC8 ultimately do? It basically takes the rules that are foreseen in the crypto asset reporting framework and puts this on the level of the EU. So implementation deadline for this, for the DAC8, will be 2026. For the OECD CARF, this is more requirements or more recommendations on an international level for states. So question is, first of all, most people want to know which assets are in scope, so which assets should be reported from the service providers to the government and who's even obliged to report. So mostly when I speak about reporting obliged entities, then I talk about exchanges. So I'm not talking about pure P2P transfers. So if I have a peer-to-peer transaction or a DeFi transaction, of course there will no one be reporting these transactions. However, if I have transactions that are preceded through a crypto asset service providers, these transactions would be then, or like the value that is preceded through these transactions will be then reported to the national competent tax authorities. Which crypto assets are in scope of these reporting requirements? It's first payment tokens, so we're talking about Bitcoin, Ethereum, etc. here. Then asset reference tokens, so USDC, Tether, BUST, for example. Then equity and debt token, which means an equity share, for example, in a company, or a debt such as mortgages or bonds. And then also certain NFTs. And this is something also which is of course often discussed amongst MiCA in the context of MiCA, which NFTs are in, which NFTs are out. So mostly if it's really a non-fungible asset, it shouldn't be in when it comes down to the reporting part. These are very, very complex reporting requirements for service providers. Of course, also have implications for individuals. It's something that we already see, for example, with AML regulation, where a lot of service providers will have to do really in-depth KYT procedures, meaning know your customers. So KYC. So You as a customer, when you sign up to an exchange, you have to give them your passport, you have to give them your country of residence, etc. So this is something which you will ultimately feel on the level of taxation as well. So the question is, will it lead to increased tax transparency? Yes or no? Yes. Why? Because the reporting obligations of crypto asset service providers will not only affect the service providers since they have to report it, but of course the individual as well, because the individuals, as I am as a crypto trader that operates often with exchanges, and I'm trading on an exchange, all these trades and the value that I proceed through these trades will or will not be reported to the government. So it creates a system of checks and balances. A system of checks and balances. So this is how it looks like. So basically, right now in most countries, it's really up to the individual to declare their taxes to declare the relevant crypto government. Right now, the government, the tax authorities are mostly depending on the crypto gains that were reported by the individual. They don't get any other data. They can use blockchain explorers and search for wallets and then check, okay, has this person made more taxable income within the relevant time period? Yes or no? That's basically it. However, after introducing these reporting requirements as foreseen in the crypto asset reporting framework and in DAC8, the picture will look different. And this is what we see here on the second picture, so to say. Now, the individual, for example, I will declare a wallet address. Also, virtual asset service providers or crypto asset service providers will report their customers' tax-relevant information to the tax authorities. So tax authorities won't only get what I report, but also what the service providers report that I use. This is relevant if I only trade in DeFi. It's relevant in DeFi because of the on and off-ramp procedures, because how would I get back into fiat? And here often people say, okay, but I can pay with crypto as well, so I don't really have to go back into fiat. Yes, that's true. However, these reporting requirements also apply not only for fiat against crypto exchanges, but also for crypto to so-called retail payments. So if they proceed a certain threshold, which right now is for goods or services over 50,000 euros, then this has to be reported to the tax authorities as well. So which transactions have to be reported? It's on the one hand, the exchanges between reportable crypto assets and fiat, so buy and sell, and exchanges between one or more reportable crypto assets, which means trading, and transactions leaving a platform, for example, transactions going to a cold wallet, and then transfers for goods or services over a certain threshold, and this will be depending on the country that implements the directive as foreseen by the European Union. So we see there is going to be an increased tax transparency because when DAC8 and CARF hit, government will now get a bunch of data from crypto traders that they have to make sense of. It's something also we see right now, what criminal investigators do is they have one wallet address and link this one wallet address to multiple wallets. So you create a cluster of wallets that you know belong to one person. The same thing that they do right now in criminal investigation, they will soon be able to also do for tax purposes. And especially since there's a lot of money in crypto, of course, governments right now are taking a lot of action in this regard right now. I can just speak for myself since, as Marianne already said in the introduction, I'm currently in the board of INAPA and participating in a lot of international roundtables, have a lot of discussions with authorities. Taxation of crypto assets is a big thing right now. New tax reforms on crypto, etc. I will go into a bit more detail into that on the next slide. So, monitoring and tracing. Those people that ask me about taxes don't really ask me about taxes because they want to know how to declare the taxes, but because they want to know, can the government actually trace my tax liability? Do they even know, like, if I report, do they even know if that's right? Can they verify the information I give them? The honest and straight up answer right now is no. And the honest and straight up answer for the past is also no. Issue being that even tax advisors working with crypto, a lot of them don't, or there is no clear guidance on how to interpret tax law. So often you, even as a tax advisor, you wouldn't be 100% sure if you interpreted something in the correct way, so to say, but you would always do it through a benefit of the doubt way. So you do it the best way possible for the client, as far as the legal framework would allow for interpretation. So can government trace my tax liability right now? I would say in most cases they can't, because still possibilities are quite limited. However, they're working on that, and they are working on that quite intensely. The question is now, should I declare my tax right now? I would say yes. The question also is, a lot of people have made gains on crypto trading ever since they got into crypto, which for the most of the community is 2015, 2016, 2017, 2018, 2019, and so on and so forth. A lot of people came into crypto during the bull run in 2021 as well, of course. So, but especially for the early adopters in 2017, 2018, 2019, no one was really sure, is crypto even a taxable thing? So in most countries, there was no clear guidance, should I even tax my crypto gains? Because a lot of people still saw crypto as something which is related to online gaming, or it would be just seen as an asset that's thrown around online games, etc. So it wouldn't be really seen as something as value. This, of course, changed in most countries in 2017, 2018 after the ICOs. And then most of them released tax regulation that would just roughly outline the scope within which crypto should be taxed. The question is, a lot of people still didn't have any knowledge about how to tax their crypto gains. Also, a lot of tax advisors didn't, so there wasn't even a chance for individuals to declare their taxes made on crypto. But they didn't do the tax reporting for 2017, 2018, 2019, 2019. And now they're coming to me and ask me, Max, shall we declare our taxes for back then? And I say, see, this is of course up to you. If you want to sleep at night and you don't want to have be in doubt that at some point tax authorities will knock at your door, then of course report it. And answering to the question, is the government even able to trace back my crypto gains from back then? I can say right now they can't, but I'm not sure where we're going to stand in 4 or 5 months from now, because they are making huge progress right now as well. So saying that, also most governments know that. They know that people in the past didn't declare the taxes because they didn't know any better. So a lot of governments and a lot of jurisdictions would offer the opportunity to declare your taxes in retrospective. So you would declare your taxes now for 2020, 2021. If I do that, then I'm not liable for any criminal acts or tax evasion or tax fraud. Coming to that taxation at a national level, this is also something which is, again, very, very difficult to give a comprehensive answer to, because, like I said, crypto is, especially from a tax point of view, seen as a really new phenomenon. Characteristics of crypto transactions are in many ways unique and not really comparable to traditional assets. So what most or many authorities, governments or jurisdictions try to do is to put crypto into these known tax boxes, I will call them, which of course just works to a certain extent. So some jurisdictions also try to introduce specific taxation rules on crypto assets. For example, Austria just in Europe released its first, like as the first European Union country, a specific law on crypto taxation. So whereas in some countries, for example, a crypto to crypto, as in Austria right now, a crypto to crypto transaction, so if I trade my Bitcoin for Ethereum, would not be a taxable event. In other countries, it is a taxable event. I have to pay my gains that I made from this trade. So each and every transaction I proceed in crypto would be a taxable event, which a lot of people don't know. So right now the question is, okay, we have this wild jungle of different taxation laws within individual states. Is there any way that we could aim on a harmonization of taxation law across states, or even like within the European Union, which would be something that seems simple? I would say no, because first of all, taxation is not only very controversial, but also politically highly sensitive issue. We see that a lot of countries introduce really low taxes on many things, not only crypto, in order to get more customers and more businesses into the country and make the country attractive for new environments. Something we see with a lot of states that flourish now in the crypto industry. It goes mostly hand in hand that these states that flourish in the crypto industry have also very low taxes on crypto. So we see the importance of taxation also for the whole economy and the whole market. So common taxation rules for crypto assets, I don't think are in any view. So to what I said before about these international reporting requirements, we have to see that there's two bubbles when it comes down to taxation. One bubble is the reporting part, and the other bubble is the de facto taxation of individuals on the individual state level. So what I'm saying right now, where there is a harmonization, is in the first bubble. So we go to the reporting requirements, which are actually way closer to what we see already with anti-money laundering regulation than to the actual de facto taxation on the individual state level. So what will happen on the international level is that reporting requirements will be uniformed and will actually go hand in hand with all the anti-money laundering information, KYC information that has to be reported to the governments already. So ultimately the question arises, how would you solve the issue of filing a proper tax return? It's something I really struggled with a lot as well. I mean, I'm a lawyer myself, so of course I declare my taxes, and as a lawyer would everyone strongly suggest to do so. Extra sheets and the like have the limits. Also, there are certain service providers, and when I say service providers, it's mostly exchanges, that offer solutions, where these solutions would only apply to transactions preceded on their platforms. And then also there is a lot of tax solutions out there. When I Google crypto tax solutions, that do give you an answer on how much taxable income you have, but they don't take into account the country-specific tax frameworks, which of course works because you see how much income you make, but like I said, each and every jurisdiction has different laws. So what would be seen as taxable income in one country might not be a taxable income in the other. And then also there is a question of who do you want to share your data with. So when it comes down to filing your tax return, you of course have to provide a provider with your transaction data. And that's highly sensitive financial data. So you really want to make sure, like question arises, would you hand your bank account data with everyone you meet on the street and say, oh, I'm gonna file a tax return? I don't think so. Data security and protection issues are a big thing here. So what should a solution allow you to do? which should allow you for proper and simple portfolio management, regardless of whether it's CFI or DeFi, so you're not limited. You should have an audited country-specific solution in place that you can rely on. You should only proceed data in a highly secure GDPR-compliant manner. And also, of course, this tax solution should be known by the authorities and up to date with latest regulation, because ultimately, if you have a tax report and you take this tax report and send it to the authorities need to make something out of it. And if I present them with paper of a tax solution provider that they have never heard of, this is going to be difficult. So the key takeaways are international regulations are changing the legal landscapes in regards to crypto taxation. The tax transparency will significantly increase and consequently also facing abilities. Taxation rules are mostly unique to each jurisdiction and only compared to a certain extent. And there is harmonization inside as well. And also be careful and not rely on every crypto tax solution provider out there, but do your own research. I think do your own research. It's the same with investments. If you want to invest into something, do your own research. And it's also the same for solution providers. If you want to use a solution provider, do your own research. So this is pretty much what I wanted to sum up for this presentation, and I'm happy for any questions that arise. Like I said, I can't give you tax advice right now for like, is this a taxable event in my country, yes or no, because I think this is up to tax advisors, and if I'm a pro trader, so to say, I should in any way always consult tax advisor. So, any questions?
Thank you, Max. I'm going to give first the opportunity to the community to make questions, otherwise I have a couple. Does anyone want to?
I know taxation is a quite hard topic, so I try to present this in the most easiest and digestible way possible. If you haven't understand something, please just ask me.
Well, it is not questions. I actually wanted to ask you to talk a little bit more about when you mentioned with DeFi, because now with the current proposal of the Parliament, DeFi might be added into AMLR, which means that is going to be more close to actually be taxable as well. So can you just like give us your perception on what is the future of DeFi and taxes? Sorry, Vanessa, can you please mute yourself if you are not asking a question? Thank you.
So the question about DeFi transactions, there won't be any reporting obligations within DeFi, because the question is always who's the subject of international reporting requirements, and by now this is mostly compared to the traditional finance, where reporting obliged entities would be banks, for example, right? So everyone that proceeds transactions, or Visa, MasterCard, etc. However, with crypto, that's very unique. DeFi transactions that are proceeded between individuals, so you don't have an intermediary that would proceed this transaction, or you would go through smart contract, etc. But this smart contract, of course, can't report to the government the taxable tax information that is relevant. So no, right now the tax reporting obligations, and I'm talking about reporting obligations. Remember the two bubbles. First, reporting won't apply to DeFi. However, on the de facto taxation, we are on the taxation now that each and every one of us has to pay taxes. Will tax apply to DeFi transactions? The simple answer is yes, of course. Each and every DeFi transaction that I proceed is important from a tax point of view as well, because ultimately it's it has financial value, and if it has financial value, and there again we're talking about now, So if they have a financial value and there's a transaction happening, yes, they are relevant from a tax point of view, and yes, they have to be reported. However, like I said, this won't be covered by the reporting obligations for service providers. But that doesn't take away the reporting responsibility from me as an individual who conducts DeFi transactions. Does this answer the question?
Yeah, perfectly. Thank you. Does anyone has more questions?
Sorry to disappoint you all.
Sorry, what?
Sorry to disappoint you.
No. I was just actually like wondering, like it's clear that like the individual has the obligation to report. I was just like wondering how easy it's going to be once AMLR, if AMLR goes into DeFi apps as well, to be able to be reported. But yeah, makes sense. Your answer. Does anyone has more questions in regards to taxes, to anything that was presented, everything that like something that was not presented, and that you would like to know? So otherwise I have another question, but I don't know if it's too specific, Max, and it's in regards to like not the case of the IOTA Foundation specifically, but for other protocols where you need to pay gas. Like how does the taxes works there? In particular, when you have users that do not want to go over the whole process of like paying the gas, and they subcontract a third party and actually execute certain actions via these third parties. Like there is like some tax implications for the user, or is only in the third party that is actually doing that? And I'm just like asking general. We don't even have gas in IOTA, so I'm just like trying to present it like general. How does actually work in those cases?
So first of all, you have to ask the question: what are gas fees? The transaction fees, right? So also, and then again, it's really depending on the actual, because you know the discussion about staking and lending. You know, a lot of, and I will cut it short, like just by the comparison of those two. So with staking and lending, a lot of service providers are offering staking to their customers. From a legal point of view, and looking at it with financial background, you would clearly recognize that this process is not staking, but rather lending. But not always, and this is something which is very, very important, not always what is considered to be a certain type of transaction is actually the transaction what is behind that. So you really have to look there on a technical level what's actually happening. But when it comes down to gas fees is something which you might be able to conduct from your taxable income, depending on the tax jurisdiction you're based in. And if you do it via a third-party provider, then I would guess that you will transfer your assets to this third-party provider. This third-party provider acts as an intermediary that will proceed transactions for you, and then you would get the rewards back. So yes, if that's the case, and the third-party provider is proceeding to transactions for you or on your behalf, then this third-party provider most likely will be obliged to report under international tax reporting requirements as well. If that was the question, I'm not sure if that was the question.
Yeah, that's the question, but also like thinking what happened when there is a transfer on the of the token itself. Like, so you are working with a service provider, and then there is a transfer on the tokens, but like let's say you are using them for staking, for example. So who is actually like the obligated party there? Is just like the service provider, or is it me? Or is it both? Do I need to report individually because it's my like, even though if I'm not using them, like or like I'm just like staking, or it was a lending, if I'm not using them, I do need to report them because there are like the ownership belongs to me, but the service provider is also obliged to report, right?
Okay, so this is a highly sensitive right now, because this is something we have discussed quite a lot now in the course of the DACA. Just to give you a quick summary on this. So the European Commission included staking and lending as services that when you as a service provider provided your customers with, then you are obliged to report under DAC8 to the government. So as it stands right now, staking and lending would have to be reported by the person that's offering the staking and lending in part, by the service provider, as well as by the individual. So in most cases, the staking and lending is done by a service provider, which would be a service provider, a crypto asset service provider under the markets and crypto asset regulation in the European Union anyways. So staking and lending would be reported by the service provider already. However, requirements, Bubble 1, don't really interfere with Bubble 2. So if there are reporting requirements foreseen in Bubble 1, so in the reporting part, then this has nothing to do with the de facto taxation that I as an individual still have to declare all my taxable income. So just because the service provider is reporting as well, doesn't mean that I now don't have to report. In fact, what the government wants, and this is what I called before a system of checks and balances, which I can show you here again. What they want is to have information being provided with information not just by the individual, but also by the service provider. So just because the service provider reports doesn't mean that I don't have to report. I still have to report all my transaction gains. Now also the service provider has to report. So the government does not just have to rely on what I report, but can also double check this with the information received by the service providers. Yeah, it doesn't like these international reporting requirements don't make taxation easier for individuals, so to say. They make it actually harder, because now the government has more information to verify the accuracy of the data provided by the individual.
Perfect. Does anyone has another question? Oh, but I cannot hear.
There's a question in chat. Do most countries tax the sale of an NFT for Shimmer, and then again when selling Shimmer for Euro? Selling physical art is not taxable in most countries, as far as I know, so it seems quite weird to double tax like this. Do you think it would change for digital assets? Okay, like I said, this is really depending on the NFT, to be honest, what kind of NFT it is. And then the question is the actual trade seen as a taxable event in the country that you're a tax resident in? So in most countries, the sale of an NFT would already be considered a taxable event. As it stands right now, yes. And also, by the way, a lot of countries charge VAT, so value-added tax on the sale of NFTs. In certain cases, of course. So this is like with NFTs, that's a bit more difficult. But question is, NFTs right now are very hard to discuss because there's a lot of uncertainty with NFTs and how they are affected by the current legislation. So I would rather look at, for example, and this question is already relevant in the sense, for example, of Bitcoin and Ethereum. The question is crypto to crypto even a taxable event, yes or no? So is trading a taxable event? If I trade my Bitcoin for Ethereum and I trade it back, do I have to pay for my gains, or do I just have to pay when I cash out against back into fiat? So, and this is really different across countries. So, for example, in Germany, it would be a taxable event. In Austria, crypto is not a taxable event. So is in France. But I can't give you a comprehensive answer on this, like a precise answer, because like I said, you have to recheck it down on the individual level. But yes, and this is why I said it's so important to have a country-specific solution in place, and not just if you use a crypto tax solution provider, don't just take it like a generic output. It really needs to have something where you say, can trust this is applicable to my country. the tax law that we have in there.
Any other question? If not, thank you, Max, for your time and for the insightful information that you just gave us. For those that are on the call, I'm going to share the recording on the regulatory matters. And I'm going to also share the presentation. And Max, if it's okay for you, I'm going to share your LinkedIn profile there. So those that want to get in contact or follow up with any questions can reach out to you via LinkedIn. Or you can send me your email if you want, and I will send those details on how to get in contact with you.
Guys, I'm more than happy. I'm more than happy if you follow me on LinkedIn. You can ask me questions. I'm actually posting quite a lot of regulatory content in regards of taxation. Also, I would be happy if you check out, of course, Blockbit. We are actually the only country-specific tax solution provider within the European Union. So happy if you check us out and give me some feedback about our software as well.
Awesome. Then I'm going to share directly there your contact, and I'm going to also send the website of Blockbit so everyone that is interested can just go explore and contact you with questions or feedback, as you said. And again, thank you very, very much for your time. And thank you everyone for joining us. I know it's late in Europe already, so I wish you all a nice afternoon or evening.
Thank you, Mariana. It was a pleasure. Thank you.
Thank you.
Bye-bye.
Bye.